At this point, you should have finished the core case in Practice Lab and compared your work to the answer key. If so, then it's time for a review of the core case. By now, you probably know the process. Before going into the 2021 tax return, take a quick look at the 2020 return for clues about what to expect on the 2021 return. So, taking a look here, what we see is interest, some dividends, pensions and annuities, most but not all taxable, some capital gains and losses, which typically involves sale of stocks or bonds, and a total income, total AGI of $16,082. So basically, this is a retired couple with some investment income. If you look at line 6, Social Security benefits, you'll see that while the total benefits, $25,304, were fairly substantial, the taxable amount is 0, and that's because non-Social Security income is relatively small. So turning to page 2 of the 2020 tax return, Form 1040, the couple took the standard deduction. There wasn't any reason to try to itemize because the standard deduction was more than AGI, so there's no taxable income. They had $1,405 withheld from various sources, and they're going to get all of that back on their tax return. In the student guide in the prior year tax return 2020, there is a 4th page, Schedule B. There isn't anything particularly interesting there. If there had been a lot of different sources of interest and dividend, then you would want to take a look at the 2021 tax documents to make sure that either all of those sources of income were again represented in 2021, or that the taxpayer could confirm to you that there had been some interest or dividends from a source in 2020, and there was a good reason why they didn't have any of that in 2021. In looking at the intake booklet, you may have noticed that Mr. Cantor listed his first name as Sam, whereas on the SSA 1099, which is the official name because the Social Security Administration and the IRS share that information, it's Samuel. So which do you put into TaxSlayer? And the answer is it doesn't matter. The IRS computers match the first 4 letters of the taxpayer's last name, in this case C-A-N-T, against the Social Security number, and what you do with the first name is irrelevant. So if you want to be obsessive compulsive, you can insist that what goes into TaxSlayer is exactly the same thing on the Social Security SSA 1099 or the Social Security card, or you can be more flexible. It doesn't matter. So let's take a look at the interview notes because, as you know by this time, hopefully, there are 2 things you need to do before you start on the tax documents, entering those into TaxSlayer, and those are charitable contributions and the EIP-RRC. So in this case, the couple donated $200 of stuff to Salvation Army. That is not something that can be used for the special charitable deduction for 2021. It has to be a payment by check or credit card. As far as the stimulus payments go, they got $2,800 in March. That's 2 times $1,400. That needs to be entered into TaxSlayer. So that takes care of those 2 things, but a digression. Normally, taxpayers are cash basis calendar year entities for the personal income tax returns. That is, what happens between January 1st and 31st is all that goes into the tax return, and what happens has to be cash in or cash out. So following that principle, the stimulus checks received in January of 2021, the second stimulus round, really belongs to 2021. But of course, Congress can change the tax law, and in this case, they did. They basically said the second stimulus payment belongs to tax year 2020, regardless of whether you got it in December of 2020 or January of 2021. So here's a better example. Suppose a taxpayer began working in December of 2021, but didn't get their first paycheck until January of 2022. So the taxpayer is a cash basis entity, and the work done in December of 2021 is not on the 2021 tax return. The employer is going to send out a W-2 for 2022 that will include the December work. And that W-2 and the payments for the work, of course, then go on the 2022 tax return. So back to the interview notes. The Cantors took the standard deduction, but often you're going to have taxpayers who come in and say, hi, I got some property tax bills, or I paid vehicle registration, or I had some medical and dental expenses, and can I use those for my tax return? Or this donation for $200 for that matter. And the answer, of course, is no. If you can't construct a list of itemized expenses that exceeds your standard deduction, you're going to use the standard deduction. So that has to be explained to the taxpayer. And you can also say, this is fairly useful, that unless you've got mortgage payments, mortgage interest, or very high medical expenses, it's very unlikely that you're going to have enough itemized expenses to take the standard deduction. Those are the two big drivers, mortgage interest and medical expenses, mortgage interest being more common. There isn't really anything to review for the two Social Security statements, SSA 1099 or the 1099-R for the pension. So let's turn to the Consolidated Broker Statement, which you're looking at the first page of right now. And the first page is a 1099 div and a 1099 INT, and you've also had experience entering these into TaxSlayer. There's nothing much to see here. So let's move on to the next page. So let's take a look at page 2. There's a 1099 miscellaneous form, but there's no values there, no amounts, so that can be ignored. And a 1099 OID, original issue discount, which similarly has no values and so can be ignored. And then there is the summary of 2021 proceeds, which are sales of stocks, bonds, index funds, etc. So there are two lines that have values: short-term transactions for which basis is reported to the IRS, and long-term transactions to which basis is reported to the IRS. Some of you might know of these transactions as being Code A, the 52,000, and Code D, the 26,000 in proceeds. The second one not reported would be Code B, short-term, and the not reported to the IRS long-term would be Code D. But TaxSlayer doesn't use that terminology, A, B, D, and E, so we won't either. We're going to come back to page 2 because that's what's get entered into TaxSlayer, these summary lines. But let's go on for a moment and take a look at what else is on this summary statement. So here is some information that doesn't have any relevance because it's all zeros, but there are expense information here. Again, it's all zeros. But if there were expenses, these could potentially be used for itemization on the California tax return. These are what's subject to 2% of AGI reduction. We'll talk about that some other time. But basically, it's no longer, these kind of expenses are no longer usable for federal itemization. Here's page 4 with short-term proceeds, short-term gains and losses listed. Again, we're going to report this in TaxSlayer as a summary line and not list the individual transactions. Page 5 is similar. There were two long-term gains, that is, the stock was, or bonds were held for at least a year before they were sold. Short term is less than a year. And again, we don't put these into Tax-Aide individually. That just takes up a lot of time. We put them in as a summary line. That's already on page 2. And finally, the last page has some information about 1099 div transactions and capital gains. This can be useful if some of the proceeds of interest or dividends are tax exempt and you're trying to figure out whether they're tax exempt on the California tax return as well. We don't have any of that in this particular case, so there isn't anything useful on page 7. So we're going to come back to page 2, and let's see how we put this two summary transactions, summary lines, into Tax-Aide. Let's take a look at what the broker statement looks like when you enter it into Tax-Aide. So the broker statement was for both the taxpayers. You check both. For the description of property, anytime you have, and we're going to put this in as a single line of all the short-term gains summarized in a single line that goes into Tax-Aide. Anytime you have that, you generally use the name of the brokerage company as the description of property. You've checked alternate option rather than entering a date because these various transactions were purchased, various stocks were purchased at different times. And the date sold is similarly different. So you check that and select if you're going to leave that one blank. Under the alternative, what you should have said was short term, various dates purchased. Now, the nice thing about date sold is you can check alternative option and not select any particular thing, because down here at the bottom you're going to click M for multiple transactions. You have to do that to be correct. And if you do that, then Tax-Aide is quite happy to say date sold and not to select any particular option. So note it says select if applicable. Whereas here, while it said select as applicable, you absolutely needed to pick one of those. The sales price comes from the transaction line. The cost basis was reported to the IRS. That's shown at the top of the page 3. The cost is also from the transaction page. You make no adjustments. And again, clicking M is critical here, both to be correct and also to have that date sold alternative option work. So we click continue. And we're going to look at the long-term transactions, which is pretty much the same. The only difference here is description of property is go-getter fund. That can be done because both long-term sales were from the go-getter fund. I would be inclined more to do Sonic brokerage, quite frankly, but it doesn't really make any difference. So everything else is the same here. We've selected alternative option for date sold, and we've clicked M. That's critical. So pretty straightforward, very similar. Let's take a look at the answer key. There are two things that are of interest. One is that Social Security has now become partly taxable. $5,810 of the $25,000 is taxable compared to none on the 2020 tax return. And that's because we have $17,000 of capital gains. And as I said earlier, the more non-Social Security income you have, the more Social Security becomes taxable. Social Security can become taxable up to 85%. It's never taxable on the California tax return, however. So that's one thing of interest. Second thing is if we go down to the taxable income, so we subtract the standard deduction, to go down to the taxable income, we have $8,800 of taxable income. And the lowest tax bracket, marginal tax rate for federal returns is 10%. So you might think, okay, you have $8,807 of taxable income, so the tax should be $880, and it's not. It's $256. That's because taxpayers who are in the lowest two marginal tax rates, 10% and 12%, do not pay income tax on long-term capital gains or on qualified dividends. So part of this 8807 is essentially still not taxable because the taxpayer is in, I think in this case, the 10% marginal tax rate. This completes the core case for Cantor, case number 3. Please pause the video until you have done the expanded case in TaxSlayer. Okay, now it's time to review what was done in the expanded case. Entering the 1099-R from the post office is the most complicated thing we've encountered to enter into TaxSlayer so far. That's because box 2A, the taxable amount, is blank, and we need to figure out how much that should be. Before we figure out what goes into box 2A, and here it's just the amount same as box 1, let's make sure that the rest of the information is entered correctly. So we've put that in, made sure we got the federal income tax withheld, make sure we've got California information down at the bottom here because there was tax withholding, otherwise that wasn't required. So box 2A. Let's go up to box 2A here, and before we actually start the calculations, a little bit of background. The reason the taxable amount is not equal to the gross distribution is because Mr. Cantor contributed after-tax dollars to his pension. We know that because box 9B, total employee contributions, is a number, positive number, $76,000 and change. So some of that $27,658 that Mr. Cantor received in 2021 is actually his money, his post-tax money, and he should not have to pay taxes on it again. So we have an option here. Click for options. Do you need to calculate your taxable amount? You click on that. And there's something called the Simplified Method worksheet. That's what you use to allocate, to distribute the taxpayer's contributions to the pension plan so that the taxpayer doesn't pay tax on that again. So click on Begin. And I note here that there actually are 2 different worksheets available. This is the first. This is built into TaxSlayer. We'll go through this first, and then we'll consider an option to that. So here's some blurb. In this particular case, Mr. Cantor was under the age of 75 when he started his annuity, is what they're calling it here. So we can use the simplified method. We click on Continue, and it asks a very odd question. Plan cost at annuity start date. This is Mr. Cantor's contribution from box 9B. And if you get that plan cost at annuity start date figure correct, then you pretty much have solved the problem. Everything else is pretty straightforward. Starting date of the annuity, we know from the problem, is 2010. This is a joint or survivor annuity. What that means is that if Mr. Cantor dies first, the annuity would continue with his wife. There is no death benefit exclusion. If this is a joint or survivor annuity, we add the ages of the recipient to enter into this box. So Mr. Cantor was born in March of 1950. He was 59 years old on January 1st, 2010. His wife was born in 1954. She was 55. At the start of the annuity, you add 59 and 55, and you come up with 114. This thing was paid for 12 months during 2021. The amounts previously recovered is not a required entry. What is being asked here is the reductions, the difference between box 1 and 2A in the previous years. Again, not required, so we click Continue. And it says what we're going to do is the taxable amount is $25,122. We click enter, continue, and we have a locked-in amount of $25,122 as a taxable amount, about $2,500 less taxable than what the default was, which was the amount in box 1. So I said there are two different ways to do this. Let's do the other way. So we're going to click here to make changes, and we're going to delete the worksheet that we just did. So we click here, and we click delete, and we're back in this particular case. And now we're going to go somewhere else, come up with a number for box 2A, and simply enter it into box 2A. Here's the alternative. We go to cotaxaide.org/tools. CO is Colorado, so this is the Colorado Tax-Aide organization, and an individual named Jeff Bogart has created a whole set of tools. So we go to this page and we find the tool you want. And the tool we want is right here, the Annuity Pension Exclusion Calculator. Click on that. We put in the name of the taxpayer, Samuel Cantor, because we're going to print this and we're going to put it in with the taxpayer's tax documents so that hopefully the tax preparer next year, when they're looking through the prior year tax documents, because I think they might find a useful worksheet, will actually find the printout. So we're looking at an annuity type for this tax year. The annuity start date was January 1st of 2010. The annuitant's birth date, this is Mr. Cantor, was March 28th, 1950. And the spouse's birth date, and it says enter only if a joint annuity. This is a joint annuity, so Naomi Cantor's birth date is October 30th, 1954. There's our 114. This is not a gross distribution. This is the gross distribution, and you check if it's a railroad RRB 1099R, which is not. The gross distribution is what's in box 1, which is what actually box 1 is titled, and that's 27,658, rounded down, 27,658 and some change, rounded down. And then total annuity contributions is our box 9B, total employee contributions, 76,092. 092. All of these boxes here are grayed. We can't enter anything. We click here to calculate, and we have information that goes into box 28, shows what goes into the 1099R, and here's a summary of worksheet. And down at the bottom here is a tax exclusion table showing the amount of and finally, we have a tax exclusion table which shows the amount excluded from taxation each year, starting with 2010 and going through 2021, and listing what will happen in future years, which is very useful if the exclusion is about to run out and you want to inform the taxpayer that they're going to be looking at a higher taxable income very shortly, a year or two, and therefore more taxes. So we come back to the 1099R, which has been waiting patiently for us, enter the 25,122, go down, click continue, get this absurd warning that says basically box 1 doesn't equal box 2A, click on continue, see something that doesn't apply to 2021 because it's a 1095E, you say was not due to a qualified disaster, and you click continue. And you're done. Now let's look at the transaction for the sale of inherited stock. And the issue here is that box 1B, date acquired, and particularly 1E, the cost or other basis, are blank. They are blank because West Coast Brokers was not involved in the purchase of this stock. It was transferred to the broker's company from the settlement of an estate. And so they don't know, the computers don't know the date acquired, or again, more importantly, the cost. Fortunately, the taxpayer has told us the date of the acquisition, which doesn't really make that much difference. Inherited stock is always treated as long-term. But the taxpayer also knows the value of the stock at the time of the death, the date of the death of the uncle. So that is 2,059 and 0.465 times 5, which is just under 10,300. So let's take a look at how that's entered into TaxSlayer. But before we do, note that box 5 is checked. This is a non-covered security. Non-covered means that the basis is not reported to the IRS. So the IRS computers don't know what the proceeds were. They don't know what the profit is. And so if the taxpayer for some reason had not filed a tax return, and the IRS were to do a rough calculation of what the taxpayer owed and send them a notice, they would actually say, you have a profit of $14,505.60, because the IRS computers assume, as the first cut, that the IRS computers are programmed to assume that if the cost basis is not reported, then the cost basis is zero. And this can result in a very large amount of taxes being assessed because, again, the cost basis is wrong. That gets fixed by filing a tax return that says, no, the cost basis is this instead. That's way off the point here. That's way off the topic here. However, the taxpayer is filing this tax return on time, and the IRS computers are going to be happy to be told what the cost basis is. So let's turn to TaxSlayer. So what does this transaction look like in TaxSlayer? First, we've checked Samuel Cantor because this was an inheritance, but quite frankly, it makes no difference whether you had checked any of these. It's not going to move the tax consequences at all. Second, the description of property, you have 30 characters there. Some returning counselors may think they only have 15 because that used to be the limit. If you find they're abbreviating that unnecessarily, you can let them know. This is critical. Alternative option, rather than putting in the date. If you put the date sold in, which is in March, you're going to have TaxSlayer insist this is a short-term transaction. It is not. It is a long-term transaction. So you tell it it's a long-term transaction, which has very different tax consequences, favorable to the taxpayer if it's long-term. And it sounds, yes, odd that it says various long-term. Various implies multiple transactions, but that's the only way you can force it into long-term. Date of sale of September, price, sales price is from the 1099B. Cost basis, this is real important. You've said it's not reported to the IRS, which you know because the price of the purchase price on the 1099B is blank. Here's your cost, as we discussed earlier. You do not check M because it's not multiple transactions, and that's the way you enter it into TaxSlayer. In the expanded case, we've added some estimated payments that were made for the 2021 tax return. You go to Payments and Estimates, go into Federal Estimated Payments, and there's a transaction you would have put in. Let's take a look at that. So here are the four $250 estimated payments made. This looks straightforward. There are some nuances. Number one is those dates that are listed on the screen, April 18th, June 15th, etc., are approximate. So if the taxpayer made the payment on April 20th, it's not a big deal. The one that is a big deal is the January 15th, 2022 date. If you go past that date, the IRS really shouldn't accept your estimated tax payments. They might apply it to the next year. I have never run into one of these before, but if you have the taxpayer saying, oh yeah, I made that payment after that 15th of January date, you need to talk to an experienced counselor about what to do. Second, while these payments are the same amount, there is no requirement that that be the case. It may be, for example, that the taxpayer skipped a payment, paid a little bit less on one of these and paid a little bit more on the other, and you simply enter the actual dollar amounts paid, including blanks if there was no payment. Third, the amount applied from a prior year refund is a dangerous area. That is, do not encourage taxpayers to use their refund for the next tax year as equivalent to an estimated payment. It is very easy to miss that when you prepare the return the next year, when somebody prepares the return the next year. Another nuance here is that while estimated tax payments can be very reasonable, particularly for a self-employed individual, they are less than desirable as taxpayers get older and potentially more forgetful. So if you have a taxpayer with Social Security or a pension or IRA withdrawals, it's good to encourage them to increase their withholding from those payments, that income stream, and stop making estimated payments. They can save on this postage and the envelope, and that's one less thing for them to remember. And they may say no. They're perfectly happy putting 4 envelopes in the mail, but at least if you talk to them about options, again, if they have options, you're planting the seed, and maybe next year when a different counselor talks to them about that, they may say, oh yeah, somebody else said something about that. How would that work? And then you explain to them how they increase the withholding on Social Security or a pension or IRA. And finally, if they have withholding from 2021 and it makes sense, that was the logical way to do it, then, and particularly if they have no other alternative or they aren't interested in doing withholding from something else, then you need to give them estimated payment vouchers for 2022 because they want to do the same thing. So how do you do that? Let's click continue and continue. And if we scroll down, we have vouchers for 2022 estimated tax payments. So let's click begin there. The critical thing when you put dollar amounts here and the vouchers are printed, the 1040 ESs, is to tell the taxpayer that these are aspirational. These are not set in concrete. These reports are not reported to the IRS. If the taxpayer doesn't like the amount printed on the voucher, the 1040 ES, they can line through it and write a different amount in. So what you're doing essentially is giving them something, a voucher, to accompany the check to make sure that the check, whatever the amount is, goes to their account and not to somebody else's for the IRS to know why they're getting that check. Estimating the dollar amounts, coming up with the right dollar amounts, is an art, not a science. Obviously, in this particular case, if $250 a quarter had worked out, you would just put in $250. If the taxpayer thinks they're going to make less money or more money, you would make adjustments accordingly. Again, the point about it is that you're generating these vouchers for the taxpayer to accompany their checks so that the IRS knows why they're getting a check from the taxpayer. Making estimated tax payments through the 1040 ES vouchers, mailing them in quarterly is one way. It's sort of the traditional way of paying estimated taxes, but the IRS makes it easy to make payments in other ways, and in fact, younger taxpayers may prefer to do it otherwise. So if we click here at the irs.gov site, make a payment, paying the taxes, and we go down to pay by bank account for free. Click on that. and we want to make a payment. And basically, here's the way to say you're making a estimated tax payment, and it applies to your 1040 ES, and this is the tax period. Click on continue. So the point is that this is an easy way for younger taxpayers to pay just as much as they want by going online and taking care of it that way. Now it's time for the what if questions. Question 1. What if Sam does not have information about the cost, the basis for the inherited stock that he sold in 2021? The answer is that while there are occasionally situations where putting down 0 as the cost basis won't actually negatively impact the taxpayer because they're in the 10 or 12% marginal tax rate bracket, and because they don't have other things that increase when profits increase on the sale of stock, that's pretty rare. So you have to look it up. The Duckbook has a couple of suggestions for where to go. This is bigcharts.marketwatch.com/historical. You need to avoid the temptation to put the stock symbol up here and go down to the slower one where it says historical quotes. Put in the date, click on lookup, and here we are. The high for the day was 211,374. The low for the day was 2,519. You add those two up and divide by 2, and you get the price that's listed in the student guide. Sometimes the taxpayer doesn't know exactly when they acquired a stock, whether it's inherited or not. In that case, what you do is get a rough figure. Hopefully they can narrow it down to a year. And then you take a look at the high and the low for the year, and you pick the low because that increases the profits the most, and that is the most conservative approach to take. And you use that. Put a note in the return why you did it that way. You're good to go. Question number 2. What if Sam died in August 2021? How would that affect Naomi's tax return? Well, first, the tax return that Naomi would file would still be a married filing jointly. As long as the taxpayer or spouse died in a calendar year, then they're considered to be alive, at least for the purposes of filing a tax return on December 31st. Second, you probably want to rearrange things in TaxSlayer so that Naomi is listed first and Sam is listed second, because in 2022, Sam is going to fall off the return. It's going to be Naomi filing a single return. There's another impact in California community property state when a spouse or taxpayer dies, because the value of the property of the couple resets. This is a pretty known factor for houses. If you couple own a house jointly and one of them dies, the value of the house is reset, and if the other one, this were to sell, the surviving spouse were to sell the house the day after the death, that would be unusual, but perhaps it was in the process, there would essentially be no gain on the house because the value would have been reset the day before to the market price, and then it would be sold at market price, and so there's no gain. The other thing is the value of stocks and bonds that the couple owns. Those get reset to market value as of the date of the death of the non-surviving spouse. So let's see if that makes any difference in this tax return. Here's page 3 of the Consolidated Broker Statement showing short-term sales. And notice that we have 2 sales that occurred in November. There's one. And here's one. So the value of that sale of those stock, Sonic Energy and the Go-Getter Fund, would need to be changed from what shows on the tax reporting statement. It wasn't the price that they were originally purchased for back in May of 2021 or June of 2021, that whatever the price was as of the August date of death of Sam. And it's possible the brokerage would issue a corrected statement, but it's also possible that you're going to have to put a note in the tax return for purposes of helping the taxpayer should the IRS come back and question why their numbers don't match the numbers that are on the tax return. Here's page 4 showing long-term gains or losses, and the 2 sales were done in February of 2021, so they would not be affected by a death in August. What if question number 3? What if the Cantors filed their 2021 tax return after the April 18th, 2022 deadline? Would they owe penalties for late filing? Well, the answer depends on whether they owe money or they don't. In the core case, they were getting a refund. In the expanded case, they owe money. If the taxpayer is getting a refund, the IRS doesn't care whether they filed late. There are no penalties and there are no interest charges for filing late when there's a refund or nothing owed, because penalties and interest are assessed as a percentage of what was owed. And so 5% interest on 0 owed or 5% penalty on 0 owed is still 0. Stepping back a bit, it's worth noting that the IRS computers will take information reported by various payers, income information, and calculate whether the taxpayer owes money or not. And if the taxpayer, according to the IRS computations, does not owe money, the IRS will not notify the taxpayer. And if the taxpayer does not file within 3 years of the filing deadline, they have lost the ability to claim that refund. But let's go back to the main point here, which was, what if the taxpayer does owe money and does file late? If the taxpayer owes money and files late, the IRS may assess penalties and interest. And I emphasize the word may, because the IRS has a tolerance, a threshold, below which they will not bill the taxpayer. They don't advertise that threshold, of course, so it's best to warn the taxpayer that there may be penalties and interest assessed, but there might not be. Also, as a general rule of thumb, it's good to be able to advise the taxpayer that if they are billed by the IRS for what they consider to be an excessive amount of penalties or interest, they should contact Tax-Aide and ask for help. And among the help that we can offer is to help the taxpayer file a request for the IRS first-time penalty abatement program. There are some requirements. This is discussed at some length in the Duck Book. But if the taxpayer has a history of filing timely and paying what they owed and can pay what they owe for the tax year they're filing, then this program is a definite option. Warning the taxpayer that the IRS may bill them is the same approach we take when the taxpayer owes a lot of money, over $1,000 on the federal return, over $500 on the state of California. In fact, the state of California, the Franchise Tax Board, has a history of being more aggressive about billing even for relatively small amounts. So it's definitely worth telling the taxpayer, if they owe over $500 to the state of California, that they may get a letter with billing. One final note. We do not enter penalties into TaxSlayer. TaxSlayer has that option. We do not enter penalties into TaxSlayer. We let the IRS and the Franchise Tax Board invoice the taxpayer and let the taxpayer deal with that, or hopefully be able to come to us for help. But we do not preemptively assess the taxpayer for penalties. This concludes case number 3, Cantor. You're now ready to move on to case number 4.